It is Wednesday, the 4th of February, 2026, and what we are seeing right now across precious metals markets is not just a recovery, not just another volatile swing, and certainly not something that can be understood by staring at price charts alone. Over the last 48 hours, gold has surged more than 15% from its Monday lows, restoring roughly $4.7 trillion in market capitalization in just 2 trading days. Silver has moved even faster, rebounding more than 26% from its lows and adding close to $1 trillion back into its market value. In total, nearly $6 trillion has rushed back into precious metals in under 48 hours. Gold alone has climbed nearly $700 per ounce from the lows earlier this week and has now reclaimed the psychologically critical $5,000 level. But while most people are watching the price recovery and debating whether this move can hold, they are missing the far more important story unfolding beneath the surface. This moment is not about price. It is about access. It is about availability. And it is about a physical market that is quietly breaking while the paper market attempts to stabilize. As gold and silver prices rebound sharply on screens, silver is vanishing from the physical system at an alarming pace. In just one single day, another 5.9% of silver was removed from vaults. This is not rumor, not speculation, and not opinion. This is documented, reported vault data. At the same time, in China, an enormous surge of retail and institutional demand has poured into banks offering gold products, overwhelming digital infrastructure to the point where bank apps became inaccessible. Gold prices dipped briefly, retail buyers rushed in to buy what they believed was the bottom, and bank apps simply stopped working. People were locked out, unable to purchase physical gold even when they had the capital and the intent to do so. That is not a technical glitch. That is a warning. When demand spikes suddenly and access disappears, the problem is never demand. The problem is supply. For new viewers, it is critical to understand one thing clearly. This channel has not and will not ask for money in any form. Anyone doing so in my name is running a scam. This analysis is built on data, vault reports, market structure, and real-world signals, not recycled hype. If you are looking for sensationalized predictions and endless claims of imminent collapse, there are plenty of copycats happy to do that. My focus is facts, even when those facts are uncomfortable or inconvenient. And right now, the facts point to a growing disconnect between paper prices and physical reality. What is happening in China deserves close attention. On paper, prices suggest ample supply. In reality, systems are overloaded, access is restricted, settlements are delayed, and physical metal is becoming harder to obtain. Every time this pattern appears, it ends the same way. Physical metal disappears first, and prices adjust later. Young buyers in China are not behaving irrationally. They are responding to uncertainty by choosing tangible assets over promises. When even bank-distributed gold products become difficult to access, that is not a coincidence. It is a signal that the system is under strain. As of this recording, silver is trading around $90 on Western spot markets, while Shanghai spot pricing sits closer to 104, with futures near 101. That represents a premium of roughly $14, or 16%, between Western and Chinese markets. Gold is trading near $5,050. These price discrepancies matter because they reflect stress, not efficiency. Premiums do not expand when supply is abundant. They expand when metal is scarce, where it is needed most. Now connect this to the vault data. The latest Comex silver depository report shows another 2 million ounces removed in a single day. 35,000 ounces withdrawn from Asahi, 1.1 million adjusted out of Brink's registered inventories, 400,000 withdrawn from HSBC, and 1.2 million ounces removed from JP Morgan. In total, registered Comex silver fell by nearly 1 million ounces to roughly 103 million ounces. Total Comex silver inventories declined by approximately 1.84 million ounces. That represents nearly 6% of available silver leaving the system in one day. This is not trading volume. This is metal physically exiting vaults, while trillions of dollars flow back into the precious metals complex. This is the core contradiction people must understand. Paper prices are recovering while physical metal is leaving the system. These two forces cannot diverge indefinitely. When price rises and inventories fall simultaneously, the message is unambiguous. Supply is tight, demand is real, and delivery, not price, is the pressure point. This is how paper pricing mechanisms fail, quietly at first and then all at once. The geopolitical context is accelerating this process. In Washington today, the Trump administration is hosting the inaugural Critical Minerals Ministerial, a high-stakes summit involving more than 50 nations. The goal is explicit: reduce dependence on China for essential minerals. With senior leadership driving the initiative, this meeting signals substantial government commitment to securing diversified supply chains. Silver, now officially classified as a critical mineral, sits at the center of this effort. Just days ago, the administration announced Project Vault, a $12 billion strategic stockpile initiative for critical minerals, supported by $10 billion from the Export-Import Bank alongside private capital. This structure mirrors the Strategic Petroleum Reserve, but for metals essential to defense systems, advanced technology, energy infrastructure, and electric vehicles. The message is unmistakable. Governments do not build strategic stockpiles when supply is plentiful. They do it when they see shortages coming and want to secure access before markets reprice violently. Silver's elevation to critical mineral status places it alongside materials deemed essential to national security. Its role in electronics, solar panels, semiconductors, medical devices, and defense systems is no longer treated as optional. This classification unlocks federal incentives, faster permitting, and priority treatment in national security planning. Silver is no longer viewed simply as a precious metal. It is now a strategic asset in an increasingly fragmented global economy. At the same time, China's export controls on rare earths and other minerals have intensified concerns among Western governments. This has triggered a push toward friendshoring with countries like Australia, Canada, India, South Korea, and members of the European Union engaging in bilateral agreements to secure supply. More than 50 nations are participating in cooperative frameworks aimed at mobilizing capital, accelerating projects, and identifying critical supply vulnerabilities quickly. Against this backdrop, something remarkable has happened in the futures markets. Shanghai open interest in silver has collapsed. Gold open interest is also extremely low. This is not bullish speculation. This is a washout. The hot money has been flushed out completely. There are virtually no speculators left. What remains are banks scrambling to cover short positions in a market where there are no willing sellers. Short positions are being passed around like liabilities, not opportunities. During the recent silver sell-off, something extraordinary occurred. Paper shorts found buyers who demanded physical delivery. Normally, only 1 to 3% of futures contracts result in physical delivery. This time, the percentage was significantly higher. The sell-off was not driven by retail panic. It was used as an opportunity to accumulate physical silver. While paper prices collapsed, physical buyers stepped in and removed metal from the system. This is the clearest evidence yet that the squeeze is real. Reports from Dubai confirm silver shortages, with buyers paying premiums as high as 15%. China's banking systems have been overwhelmed by gold demand. Vaults are draining rapidly. Comex inventories are shrinking. Open interest has collapsed. And yet prices have rebounded violently. The paper flush created a physical accumulation window, and that window is now closing. Ray Dalio has warned openly about an approaching capital war. Governments are positioning themselves accordingly. When nations classify minerals as critical and build strategic stockpiles, they are not reacting to abundance. They are preparing for scarcity. At the same time, risks remain. Japan's bond market is under severe pressure. Demand for Japanese government bonds is weakening, with bid-to-cover ratios falling sharply. Yields on 10-year bonds have climbed to levels not seen since the late 1990s. Political uncertainty ahead of national elections and the prospect of expanded fiscal stimulus have raised concerns about debt sustainability. If Japanese bond auctions continue to struggle, global markets will feel the strain. Treasury yields would rise, risk assets would sell off, and initial reactions would be risk-off across the board. In such scenarios, metals often get hit alongside everything else, briefly, but history shows that safe haven demand returns quickly once forced liquidation ends. The recovery we are seeing now reflects that dynamic. $6 trillion has returned to precious metals in 48 hours. But volatility is not over. Geopolitical tensions with Iran remain elevated. Any military incident could trigger short-term selling, followed by aggressive safe haven flows. Despite these risks, the physical market continues to tighten regardless of paper price action. Silver ETF demand has recovered. Open interest remains at multi-month lows. Historically, this combination signals the completion of forced liquidation. Dubai premiums persist. China's access issues remain unresolved. Vaults continue to drain. Gold has reclaimed $5,000. Those who entered short positions during last week's crash are now underwater. Bitcoin, when measured in gold rather than dollars, has declined significantly, highlighting the strength of precious metals in real terms. So, where does this leave us? Nearly $6 trillion has recovered in 48 hours. Gold is up more than 15%. Silver is up more than 26%. This is one of the fastest recoveries on record. Yet, physical inventories continue to decline. Nearly 6% of vault silver left the system in one day. Comex registered inventories sit near 103 million ounces. China faces access restrictions. Dubai premiums remain elevated. Physical metal disappears first. Price adjusts later. Governments are signaling supply risk through strategic stockpiles and critical mineral classifications. Futures markets have been flushed of speculators. Physical delivery surged during the sell-off. Japan's bond market remains fragile. Geopolitical risks persist. The unresolved tension is this: paper markets signal recovery, while physical markets signal shortage. Both cannot be right indefinitely. Watch access, not headlines. If you cannot take delivery, you do not truly own the asset. Use logic, not hype. Think independently. These are not normal conditions, and what comes next will not reward those who ignore the difference between paper promises and physical reality.